Hey, welcome to the Chapter 10, Completing the Accounting Cycle for a Sole Proprietorship presentation lecture. Please make sure that you have the notes as we go through this chapter's material, as well as possibly having access to the demonstration problems as we go through this too, which can help you with some of those processes as we get closer to closing the books on an accounting cycle for a sole proprietorship. All right, in Chapter 10, we will complete the accounting cycle. So we're at step number 8 and step number 9. So journalize and posting closing entries, and then also preparing a post-closing trial balance. The 8th step is to journalize and post closing entries. Closing entries are the journal entries made to close or reduce to zero balances in the temporary capital accounts, and then to transfer the net income or net loss to the capital account. If you remember, our temporary capital accounts are our expenses and our revenues. After we have completed the closing process of our revenues and our expenses, the revenues are closed out into a temporary account called income summary, and the expenses are also closed out into a temporary account called income summary. This is where we use, this is the holding area for these account balances until we can close it out into capital. It serves as the income statement for the ledger. Remember back when we did the financial statements, the income statement which shows us net loss or net income. Expenses that have a debit balance are transferred as debits to income summary. I'm sorry, debt balance. So if we are going to close out our expenses, we would debit income summary and credit the expense to zero out all of our expense accounts. Revenues that have a credit balance are transferred as credits to the income summary. So we would debit the revenues and then credit the income summary. Revenues and expenses then are transferred into the income summary actually represent increases and decreases in owner's equity. It's also, when said and done, going to reflect our net income or our net loss. Balance of the income summary will tell us, do we have a net income or do we have a net loss for the period? So it should reflect exactly what was showing in the income statement. Income summary is a temporary capital account, just as expenses and revenues. Used only at the end of the fiscal year to summarize the balances from revenue and expenses. Income summary does not have a regular balance side. If you take a look at page 235 in your book, that'll explain that. Depending upon whether we have a net income or net loss, it's going to determine what side balance the income summary has. Balance before and after the closing process is zero, so that gets closed out at the end of each accounting cycle. It does not appear on any financial statement. It will appear though in the trial balance sometimes. Now for preparing closing entries, the first thing we have to do is determine the balance of the revenue account and transfer it to the credit side of income summary. If you remember this acronym, Ray eats in darkness. Revenues close, then expenses close, then income summary closes, then drawing closes. So the first step is to close out the revenues. Then we want to close out the expenses. So we will debit income summary and credit the expense accounts to zero amount. Then whatever the balance of the income summary is going to be transferred to the capital account. So whatever we have to do to zero out income summary, we have to debit income summary, we have to credit income summary. But whatever we do to income summary, we do the opposite to capital. And then the balance of withdrawals is also going to have to be transferred to the capital account, and it's going to work against the capital. It's a contra capital account. So to zero out withdrawals, we debit capital and we credit withdrawals to zero it out. If we take a look at this, this is a visual aid to help you. For example, there's the analysis, the debit and credit rule, the T accounts, an example of what it would look like to close a revenue. So we have a delivery revenue balance of $2,650. We want to close that out and transfer the money to a temporary income summary account. So this way we would debit the revenue for $2,650 and credit income summary for $2,650, making the balance of the revenue account zero. Problem 10.1, which is a problem that we'll be going over in class. Take a look at this for a proprietorship on page 29. We have the closing for our revenue account titled fees. So what we are going to do in the general journal, we always start a new journal page. We will, whatever that page is going to be, in this case it is page 8, we will label this page of the general journal closing entries, and then we will begin our closing process. Notice the closing process begins on December 31st. So we will first close out fees. We will debit fees for 2,000 and credit income summary for 2,000. That closes out and zeroes out our revenue account fees. Now, closing the balances of the expense accounts is a little bit different. It's just the opposite. So for this one, we want to make all of our debit account balances, which are the expenses, zero. So therefore, we will debit income summary and we will credit all of our expenses for their balances. So credit advertising expense for 75, credit rent expense for 700, credit maintenance expense for 600, and credit utilities expense for 125. Journal entry, which is also known as a compound entry. We've talked about these in the past. In this case, we would debit income summary for the balance or for the sum of all of the balances of our expense accounts, 1,500, which is closing out advertising expense for 75, closing out maintenance expense for 600, closing out rent expense for 700, and then closing out utilities expense for 125. All right, let's take a look at closing out the expenses. So in problem 10.2, we notice that we have expense balances for advertising of 400, 200, 600, and 300. So to close those out, we would debit income summary for the sum of all of our expense balances, which is 1,500, and then credit each additional or each expense account that we have in our chart of accounts for their balance. Advertising expense 400, miscellaneous expense 200, rent expense 600, utilities expense 300. That now makes our expense accounts zero. They are closed out. The closing of income summary. We will have to determine what we have for a balance side of income summary. So for this one, we determine that our balance side for income summary is a credit. So therefore, in order to close it, we debit the account. We always close out income summary into capital. So a $1,150 debit to income summary and a credit to capital for $1,150. Because capital is increasing, this means that this accounting period resulted in a net income. Problem 10.3, here we go. Let's close out income summary. In this case, we have income summary with a debit balance of $500. I'm sorry, a credit balance of $500. Therefore, we have to debit the account 500 to make it zero, and we will credit the capital account for $500. That's closing of income summary. Now for withdrawals, withdrawals is a debit side balance temporary account. It also needs to be closed out into capital. So in order to close out withdrawals, we need to credit the account. So in this case, we will debit capital for the balance of withdrawals, which is 500, and credit withdrawals for its balance, which is 500, to make it zero. So problem 10.4, we have a balance of withdrawals, which is $900, so we have to close it. So what we'll do is we will debit the capital account for $900, decreasing the balance of capital, and credit the withdrawals account for $900, zeroing it out. So now we have it zeroed out, and we indicate that by closing it out into capital. So at the end of it, this is exactly what it's going to look like. We have closing entries, closing out the revenue, closing out the expenses, closing out income summary, and then closing out withdrawals. Ray eats in darkness. Ray stands for revenue, eats stands for expenses, in stands for income summary, darkness stands for withdrawals. Problem 10.5. Now we have to post them. So now we have all of these entries entered and journalized. Now we have to post them and show the zeroed out balances for our temporary accounts. So the 8th step is to journalize and post. So posting the closing entries from the general journal to the general ledger. This is what it's going to look like. The capital account, anything that is posted as a closing entry is noted in the description in the ledger as a closing entry so that we know that it is the end of the accounting period. And we have those listed there for Maria Sanchez Capital, and we have it listed for Maria Sanchez withdrawals showing the zero balance, right here. Same thing for income summary. Here are all of the transactions that took place, impacted the income summary account, and then finally showing that it is zeroed out. After we have done that and we have posted everything, now we have to construct a post-closing trial balance. The post-closing trial balance is going to have only the balances of the accounts that are permanent. All of our temporary accounts have been closed. So you'll notice that there are no expenses, no revenues, and no drawing account listed in the post-closing trial balance. Reason being, they have been closed and they have been zeroed out. Problem 10.6. Constructing the post-closing trial balance is just going back to our ledger, looking at the permanent accounts and what their balances are, and then list them and total it up to rule the post-closing trial balance to make sure that it equals. These are all problems that you'll get practice doing, and we'll be taking a look at these in your problem packets. This concludes the presentation lecture for the closing entries and end of the accounting period tasks that need to happen and need to take place. Please make sure that you review all the slides to get all of the notes, as well as review these problems as we will be going over them in class as well, so that you have a good handle on how to journalize closing entries, post the closing entries, and then also prepare a post-closing trial balance. Very good. That concludes the presentation lecture. I will see you next time we meet in class.